One of the terms that I think is very important for you to understand when it comes to trading is slippage. Now, the term slippage is a very common term amongst the traders and the trading community. And what it refers to is from the moment that you enter into a trade, once you hit that button for example, a market order, you're looking to enter into the trade. Once you hit that button to execute on it, it's that delay from when you hit that button to where the order is filled. And that could be positive or negative slippage. So let's say, for example, you place a trade and the market moves from the time that it actually fills on the chart, from when the brokerage actually fills that order, goes to the market maker where they submit the order. That time, the market can move, and it can move just a little bit or it can move a lot of it. If there is a lot of volatility in the market, especially around things like economic news announcements, earnings reports, around the market open or close, the volatility can really impact how much you are slipped on that trade. Now, that could also be for the entry as well as the exits. So, if you try to avoid slippage, you can use things like limit orders. But if you're using limit orders, you might not get filled. It might not reach that level, or you might say, I would like to get in here. And if the market never reaches it, well, no fill happens. Or it could move so fast that the market maker doesn't get that trade pushed through, and then no trade is executed, even though you did have an order. If you do a market order, it could enter you in, but you might get slipped a little bit from the time you hit that button to submit it to when it actually does fill. And that also goes with those exits. Let's say you hit the button to exit out or offset that particular trade. Well, there could be some delay and you might be slipped either positively or negatively. So a positive slip just means, well, you had a good outcome. You hit that button to exit out of the trade and it kept going your direction before it actually filled. And then a negative slip is going to be when you hit the button to get out and it keeps going against before it actually fills. So always make sure you're checking out for the slippage and accounting for slippage when placing trades.